In this video, we're taking a look at one of my favorite patterns, the head and shoulders. Head and shoulders patterns are easy to see, and that's what I like about them, because you want patterns that are easy to identify and that the market will pay attention to. The first thing I would say is there is an inverse and a standard pattern. The head and shoulders is actually a negative pattern. It's a bearish pattern. The inverse, of course, is just the exact opposite. It's bullish. A head and shoulders is a pattern that shows a rally, a trough, a rally, a trough, and then a rally and a breakdown. These are the shoulders, rallies 1 and 3, 2 being the head. You can see that it's taller than the shoulders. There's a neckline where traders will identify a breakdown point. It'll look a little bit more like this. And on a break of that neckline, you short it in this case. Or if it's inverse, it'd look more like this. The head, it's upside down. The head's taller than the shoulders, which makes a lot of sense. I would also point out that it does not have to be straight up or straight down. It can be at an angle like this. And think about the psychology of this. You have a market that's moving in a particular direction. The buyers feel good. There's a little bit of a pullback, and then they rally it again. And at that point, if you're in on this shoulder, you think, okay, good. The trend's working out in my favor. Everything's good. These people recognize that it's an uptrend, and they want to get in on the action. They see a little bit of a pullback, but they're not worried. This is a market that's been moving in their direction for a while. Then the next rally shows a little less enthusiasm. Well, these people are losing money right away. And once we break the neckline, which was the beginning of this rally or the beginning of the pattern, these people are all losing money. Well, what do you have to do when you're long of a market and you're losing money? You have to get out, and you get out by selling. So it puts even more downward pressure here. The exact opposite would be true in this scenario. The sellers feel good. They get a little bit of a pullback. We're even lower at this point, so it certainly is working out. Get a little bit of a pullback. Wouldn't be too worried about that, but all of a sudden, the market can't go as low. Once we get past the neckline, everybody in this pattern is losing money. So they have to buy to close out their position, creating more upward momentum in this direction. So let's take a look at a couple of examples. On this chart, I see a head and shoulders after this is a 4-hour of the cable. After a rally to the upside, you can see that we rallied again and then rolled over. The neckline would be this entire area here. So when you look at this, you can see that the buyers felt good, and then they pulled back a little bit, which is, it's normal. And then they rallied even further. So, of course, they're feeling good about their trade. But the other shoulder, showed signs of weakness, and that has people nervous. Everybody above the neckline now, once we break down below it, is losing money. So, one of the things that makes the head and shoulders so valuable, to me at least, is that there's a measuring stick. I love patterns with measuring sticks. You take the tallest part of the pattern to the neckline, and in this case, it's about 110 pips from 132 to 130.95 or so. Once you break down below the neckline, you are moving the height of that pattern in theory, and that would be your target. And you can see that clearly it worked out. And in fact, it worked out much better than that. It kept going. Stop losses are easy. You just put them on the other side of the shoulder, because if it turns around and breaks above the top of that shoulder, that's the breakdown shoulder, well, clearly the pattern didn't work out. So that is an example of a head and shoulders. Now, an inverse head and shoulders, as you know, is just simply the same thing, just other direction. we have that pattern here. You can see that we started to fall. The sellers felt relatively good. They feel even better there. They don't feel quite so confident there. Once they break through the neckline of the head and shoulders pattern, in this case, you've got a move of about 220 pips from the breakout at 142-ish. So you're looking for about 144.20, about there. You can see clearly it hit that. It went further, and that's not uncommon. A lot of times it'll overshoot. But the pattern would be easy to trade in that scenario. You would have your stop loss set there underneath that shoulder. You'd have your target set there. You would either take your entire profit there or take half, or at the very least be at break even. Head and shoulder pattern are great because they're easy to identify. Everybody in the world knows what they mean, so therefore everybody pays attention to them, giving more credence and more of a self-fulfilling prophecy. In this next video, we'll take a look at double tops and double bottoms.